What if I told you that an old medical receipt could legally help you access tax-free money 10, 20, or even 30 years from now? Most people do not know this game. They get a health savings account, better known as an HSA, and treat it like a medical debit card. They go to the doctor, receive a bill, swipe the HSA card, and spend the money immediately. There's nothing wrong with that if you need the money. Medical care comes first. But if you can afford to pay the bill from your regular cash flow, there may be a more powerful move. The game is to save your medical receipts and invest the money inside your HSA. An HSA is not just a spending account, it can also operate like a long-term investment account. At the federal level, an HSA can provide three major tax advantages. The money may go into the account before taxes or qualify for a deduction. The investments can grow without federal income taxes while they remain inside the account. And withdrawals used for qualified medical expenses can come out tax-free. That is a powerful combination. But you generally must be enrolled in an HSA qualified high deductible health plan to make new contributions. Not every insurance plan qualifies, so verify your eligibility. Here is what shocked me. At the end of 2025, the average funded HSA balance was only around $5,300. But HSA accounts containing investments had an average total balance of more than $24,000. Only about 1 out of every 10 HSA accounts held invested money. That tells me most people are using the HSA to spend, not to build. They are eating the seed instead of planting it. The wealthy question is not only how can this account pay my medical bill today? The better question is how can this account pay me back later while my money compounds? That is where saving your medical receipts changes the entire game. Let me explain exactly how it works.
You've tried it your way, but you're still in debt. Or maybe you're doing okay, but want to invest smarter, grow faster. MillionaireX.ai gives you real step-by-step strategies to ditch debt or stack wealth. Stop dreaming and start planning. Visit MillionaireX.ai today. I want you to be the next millionaire next door.
Let us say you receive a qualified medical bill for $1,000. If you need to use your HSA, use it. Do not put your family in financial trouble trying to follow an investment strategy. But if you have the available cash, you could pay that $1,000 from your regular bank account and leave the HSA invested. Then you save three things. Save the itemized medical bill. Save the explanation of benefits from your insurance company, if one was issued, and save proof showing that you paid the bill with your own money. Do not rely only on a credit card statement. It may show that you paid a hospital or pharmacy, but it may not prove what service or product you purchased. Scan or photograph everything. Create a secure folder for each year. Record the patient's name, provider, service date, amount paid, and whether the expense has already been reimbursed. Now, here is the part many people have never heard. IRS guidance currently says there is no time limit on when you must reimburse yourself from the HSA for a qualified medical expense. You may potentially reimburse yourself next year, 10 years later, or during retirement. But the rules matter. The expense must have occurred after your HSA was established. It must be a qualified medical expense. It cannot have already been reimbursed by insurance, another HSA, an FSA, an HRA, or another source. And you cannot also claim the same expense as an itemized medical deduction. No double dipping. If that $1,000 expense qualifies and you preserve the documentation, you may be able to withdraw $1,000 from your HSA later without federal income taxes. Think about what just happened. You paid the medical expense today, but you created a future tax-free reimbursement right. Meanwhile, the original $1,000 inside the HSA remained invested. That receipt is no longer just a piece of paper. It becomes part of your family's future tax-free reimbursement reserve. But you must protect the records. Paper receipts fade, email accounts close, medical portals change, businesses disappear. Keep digital copies in an encrypted cloud folder and maintain a second backup. Also, keep a spreadsheet listing every expense and clearly mark it once you reimburse yourself. The receipt is the evidence. The tracking system prevents you from reimbursing the same expense twice. Now, let us talk about what compounding could potentially do with the money you leave invested. For 2026, the HSA contribution limit is $4,400 for self-only coverage and $8,750 for family coverage. Let us use the family amount as an example. Suppose a family invests $8,750 every year and earns a hypothetical average return of 7% annually. After 10 years, the account could grow to approximately $121,000. After 20 years, approximately $359,000. After 30 years, approximately $827,000. Those numbers are hypothetical. Investment returns are never guaranteed. Fees matter, and the market will move up and down. But this shows why you hear some people say they are not touching their HSA until retirement. They pay current medical expenses from regular cash flow, save every qualified receipt, invest the HSA, and give the money decades to compound. By retirement, they may have two valuable assets. First, they may have a large invested HSA that can continue paying qualified medical expenses tax-free. Second, they may have years of unreimbursed medical receipts that can potentially support tax-free reimbursements. Imagine reaching retirement with $50,000 in properly documented unreimbursed medical expenses. You could potentially reimburse yourself up to that documented amount from the HSA without federal income taxes. That money could then help with housing, travel, and emergency are another family priority because the medical expense was already paid years earlier. After age 65, the HSA can become even more flexible. Qualified medical withdrawals can remain tax-free. Non-medical withdrawals generally avoid the additional 20% penalty after age 65, although those non-medical withdrawals are usually subject to ordinary income taxes. That is another game we can break down in a future video. Now, let me be clear. This strategy only works if you are eligible, the expense qualifies, the HSA already existed when the expense occurred, and you maintain proper records. You should also keep enough cash available for near-term medical needs before investing your entire HSA balance. This is not personalized financial, investment, legal, or tax advice. This is financial game I have learned, researched, and am sharing because I care. And if anything I said sounds too good to be true, do not simply believe me. Check what I said. Read IRS Publication 969 and IRS Notice 2004-50, especially question and answer 39. Speak with a qualified tax professional about your personal situation. If you believe I missed something, misunderstood something, or left out an important rule, tell me in the comments. We can all learn together. On the next video, maybe I will share some other HSA and retirement tricks that more families need to understand. Visit CPRFIRM.com for business strategy, protection, and growth. Visit millionairex.ai and download the app for more financial education designed to help you understand the game. Save the receipt, invest the HSA, give the money time, and let compounding do what it do, baby. Get out of debt. Stop listening to broke people for life. Our money tips. Majority of popular influencers are broke and broken. If you ask, I will give you the best financial influencers I have vetted and subscribed to. Remember, this isn't financial advice, but public game you can read for yourself. Download millionairex.ai, and if you need business, life advice, coaching, services, CPRFIRM.com.
Ready to dominate your industry with strategy that actually scales? At Coleman Public Relations and Consulting Firm, we're not just PR experts, we're licensed sports agents certified in AI and elite business consultants with over 2 decades of experience leading global projects across multiple countries. Visit CPRFIRM.com, that's ColemanPRFIRM.com, and MillionaireX.ai. Then download the Millionaire X app, your AI-powered guide to getting out of debt, investing smarter, and building generational wealth. Coleman Public Relations and Consulting Firm. It's a family business. It's different.
Hello everyone, come along with London and Sydney as they show you around the vibrant country of Cameroon. We explore the heart of Africa through the eyes of London and Sydney. Two explorers who journey across the great city of Yaoundé, exploring its rich culture, vibrant market squares, cultural heritage, and wildlife. With giggles and excitement, London and Sydney Explore Cameroon takes you on a fun-filled adventure, providing insight into the country's culture and traditions through the pages of this book. It's packed with exciting stories and super cool facts about Cameroon that will make you go, wow. Get your copy now, available on Amazon and in libraries near you. There's only one easy way to experience the exploration of Cameroon, and it's through London and Sydney. Don't wait, get yours.
Hi guys, I'm Kai Gabiam from the Diaspora channel, a lover of Africa. If you love Africa as well and you would love to visit one day or to relocate to Africa, there is a course out there for you. And this course is My First Trip to Africa, a course well put together by a seasoned traveler, Kellen, Kash, Coleman. This course is designed to prepare you to travel better, which will save you both time and money. And the great news is this course costs only $20, guys. It can't get any better. Go right now and enroll to this course at www.diversifygame.com. Don't miss out.